So what I'd ask you to do is, if you haven't already done so, get a pen and paper ready and take some notes, because there's some important information coming up. So in order to master markets and business cycles, you do have to study history, but we've done that for you. And in so doing, there is a degree of mathematical order. Arguably, there is very precise order. Markets and history repeat, and it's all about human behavioral cycles being quantified mathematically. I understand you may be skeptical. I was when I started this journey, and I've been doing this for well over 30 years. I'm going to present some facts to you. I'm not here to convince you. You make your own mind up. So let's kick off. And let's ease you in gently. First of all, you might already be familiar with the decennial cycle, which is all about the years of the decade. And this was first documented in 1939 by a guy called Edgar Lawrence Smith in his book, Tides in the Affairs of Men. And he saw that years ending in 3, 7, and 0, or 10, and sometimes 6 were often down years, and years ending in 5, 8, and 9 were advancing years. Now, bear in mind, in 1939, he did not have that much of a history of the Dow Jones Industrial Averages. And he asserted that this is all due to the impact of weather, sunspots, radiation, which created optimism and pessimism on humans, and therefore mass psychology. So let's simplify that last slide. The key points are that years ending in 5 over the last 120 years have been overwhelmingly bullish. We tend to start bull runs from years ending in 2. We're in 2022 right now into there. Years ending in 7 see a pullback, and then we tend to see a big run up towards the back end of each decade. Now, this is just the big picture. You know, it's just an overview guideline map. But the real secret to all this lies in super long-term cycles, and it's about knowing where to look. So I'm going to show you my work now over the last 30 years, and you will see some really interesting things. Now, how do we do this? Over here in our office in Surrey, in England. So I know you're from all over the world, and I really appreciate that. Simon's in Singapore, I'm in Surrey, and I know we've got many people here from America, Australia, all across Europe. But what we do in our office here is we keep timelines. I started logging all these events with my colleagues here, and we found some very interesting patterns within these timelines. And so this got us into studying cycles. Well, why study cycles? As I said, I've been doing this for over 30 years. And there is, you will, if you don't know already, but there is a very high level, a lot of use of cycles. And it's not necessarily shouted out about because it does work. The Wall Street brokers don't necessarily want you to know about that because they want you to be beholden to them. I'm fortunate enough, as Simon mentioned in his kind and generous introduction, to sit on the board of the Foundation for the Study of Cycles, which was set up in 1941 by the US presidency and headed up by chief economist Edward Dewey. And all the research there, which we carry on this day, looks to see if we can forecast events and therefore mitigate the extremes of the negative events and also harness the positivities of the larger events. So there is a very serious undertaking into the study of this information. So get ready. Let's start off. Fasten your seatbelts then, ladies and gentlemen. We'll take a look at the 72-year cycle. Why the 72-year cycle? This next part of the presentation is going to show you how to identify booms and busts in markets. This is worth its absolute weight in gold if you understand that. And let's start off with the 1929 crash, which you'll all be familiar with. And you can move 72 years on from that. And we got the 2001 equity tops, the end of the dot-com boom in 2000. But you can also pivot back 72 years from 1929 to 1857. And write this date down, by the way. I want you to write this date down. Let's take a look in a bit more detail. So there we go. On the 3rd of September, 1929, the Dow Jones Industrial Averages made a top at a price of 386 and then proceeded all the way into July 1932 to collapse by 90%. So I think pretty much all of you that have been in finance and markets and trading will know about this particular event. But what you probably don't know about was that back in 1857, there was a large boom and bust in America, but also in Europe, and the markets were down 62%. So, you know, Fibonacci traders, you'll recognize that immediately, very close to 61.8%. The market came down 62%. Why? The fundamental cause was a boom and bust in railroads. We reached a big extreme in there, and there were also issues with gold and the amount of gold that was being transported across the world. I'm not going to go into too much economic history, but it really is fascinating, because when you look into it, you'll see exactly the same things appearing time and time again in history. Move fast forward to 2000 to 2001, and you will see that the dot-com boom popped and the market came down 40%. And by the way, the last 5 years of the last 3 centuries have all seen 5-year bull markets. Very small sample size, but an interesting fact. So if you want to campaign for the American presidency, you want to make sure you're running for the term that ends the last 4 years, because then you're going to be credited with a boom stock market. So just an aside there, but seriously, this is how the 72-year cycle works. So when is the next crash in this cycle? 2001 plus 72 takes us to 2073. Just remember this date. Now, I know you think, well, this is no good to me. Pass it on to your kids. And actually, for those of you that are involved in our inner circles, we use these dates to project backwards from, and we can glean a lot of good information outside the scope of today. But don't dismiss these things as being long-term horizons that are irrelevant, because they're very relevant indeed. Next up, the 144-year cycle. Well, why the 144-year cycle? Particularly relevant to the commodities markets and bubbles. Okay, so let's head back to 1720. So that is just over, that's 302 years ago. 2 things happened in 1720. We saw the South Sea bubble, which was basically a series of fraudulent stocks sold, especially in Britain. People got very rich very quickly and then lost it all. But most importantly, back in France, a Scottish economist called John Law convinced the French aristocracy and the king that they should basically take the livre, the French currency, off its gold standard. And then they also created this bubble by selling land in this chosen area, the Mississippi, New Orleans. In fact, it was swampland, but they were selling a dream. And everybody got involved with this. And by May 1720, things that, I don't know, was it went up 60, 70 times and then popped. So people lost everything. Now, we'll come to bubble cycles in a minute. But let's move on 144 years from now. This is 2 lots of 72, 2 lots of 72. And we get to the American Civil War. And on the 23rd of August, 1864, the price of cotton reached the phenomenal price of $1.89 a pound. Now, let's put this into context. 6 months earlier, it had been trading at 3 cents a pound. So we saw a 60-fold increase in the price of cotton. And we also saw tremendous increases in the price of wheat. Let's go back to cotton. Why did cotton go up 60-fold in such a short space of time? Well, quite simply, because all the men that were tilling the fields, creating the cotton, were now becoming soldiers fighting on one side or the other of the Civil War. And what do you need in traditional warfare? Going back to the 1800s, you need a uniform. So the demand for cotton went massively up. The supply for cotton crashed. Simple economics of demand and supply. That's what caused the price to rocket. And we got this massive spike, then it came crashing down. Move forward 144 years from 1864, and this is where we were already well trading by then. We were able to capture this 2008 boom, massive commodity boom, partly caused by the devaluation of the dollar, and that was significant. For example, that was the last major high that we saw in Britain, with the US dollar trading at 2.11, 2.11 to the pound. I mean, it's down at 1.31 today. So this was another significant event, and they're all perfectly timed. What I want you to do is, I hope you're making notes. You could go and just check this research out for yourself. So double 72 takes us to the 144-year cycle. 2008 plus 72 puts us 2080 as a significant commodity boom top, and then we're going to see 2,157. So long-range forecasting is easy. Now you're making notes for your great-grandchildren, but there is a lot more to it, so please don't dismiss this. Now, I'm going to bring in another cycle, the 90-year cycle, a very important cycle, because this is very prevalent in the commodity markets, but it also works in the stock market. So let's use 1929 as our anchor point. And if you recall, the market came down 90% there. And head back 90 years, and we go all the way back to 1837 to 1842, where we see the Dow Jones Industrial Averages come down by 74%. Okay, so this was actually the reconstituted Dow. The Dow didn't actually start collecting till, I think, till 1895, 1894. But these are the indices we have. Whichever way you want to argue it, the market was down massively. Why? It's all to do with the policies of Andrew Jackson, who had kept a firm hold, the first national US bank. And what had happened, people were breaking away from these policies. They were starting to release fiat money. And this money led to a huge boom in speculation around the Chicago area, land prices, canal building. The idea was that the more canals you got to the Great Lakes, the more commodities, the more wheat you could get into the Great Lakes, out through the St. Lawrence Seaway and out into the world. Money was so cheap, everybody was buying land, and we got this massive boom and bust, and it lasted 5 years. So this was the 180-year cycle with a midpoint round about 1839. So very important cycle. Then what we were expecting, well, 1837 to 42, you add 90 years takes us to 1929. Add another 90 years. And I see several of our followers on this call. So you'll remember we were looking for a top in 2019, and it didn't actually come in till mid-February 2020. So it was within 6 weeks of accuracy from the year. I think that's 4,600 weeks. So, you're allowed 6 weeks tolerance over 4,600 odd weeks. And what we saw was February, March 2020 saw this massive pullback, all to do with the pandemic, and the market came down 34%. Now, the half point of the 90-year cycle is the 45-year cycle, and this is very relevant. And what we see here is that if we bring in the 1884 pattern, we were already in a depression in America here, but the panic occurred in 1884, and it was because the amount of gold, Europe was short of gold, so it was trying to get as much gold, and gold was leaving America. So again, not enough time to go into the economics of that, but just to show you that we did see a pullback there. Next one up in here really is the 1974 pattern. And so if we take 1929 and add 45 years, we had the OPEC oil crisis. Oil doubled and doubled and doubled, partly led by Iran. And OPEC basically had a stranglehold over the Western world. This is where the 50-mile-an-hour speed limit was brought in America. So we saw this huge sort of recession. I remember this. I know what you think you can't possibly do. He looks far too young, but sadly, I do remember this. In Britain, we went onto a 3-day week. We had power cuts, power outages, and we had electricity for 3 days. The trash wasn't collected, or the rubbish, if you're in England, wasn't collected for weeks, and there were rats everywhere. And the miners were basically holding the company to, not ransom here, but it was all part of the OPEC oil crisis. So move on 45 years, which is basically the 90-year cycle. But what did we see? We saw an oil crisis here. And what did we see in April 2020? An oil crisis. Oil traded negatively for a day, if you remember. So history repeats in flavors. So that's the 74 midpoint. Now, you're doing really well. We're nearly through the long-range cycles. We're going to start drilling this down into how you can turn this into individual trades. But let's look at the 100-year cycle. I think this is a particularly important one. And let's consider 2007, which saw the global financial crisis, and we'll bring this up in a minute. And if we go back 100 years from there, we had the rich man's panic. And I'll show you that in a minute. We'll also look at the half cycles of 50 years. And 1907 plus 50 takes us to 1857. Now, who wrote down 1857 at the beginning? What I want to show you here is how these big cycles are interacting and overlapping. So this is the important thing. And 1857 saw runs on banks. And So did 1907, and so did 2007. Okay, in Britain we had a run on the Northern Rock Bank. People were queuing to get their money out. So the next one in this cycle here is going to be 2057. But let's just take a look at this. 2007 global financial crisis. It's when the mortgage lenders sold their obligations in CDOs, and then people insured those CDOs with CDSs, and then you could buy a CDS and buy insurance on somebody else failing. Pretty much the dumbest thing ever done, but made a lot of money for those on Wall Street. And everybody got bailed out, and nobody carried the can on that. But anyway, what we did see was the market was down 54%, just more than a 50% retracement there on the Dow back in 2007, with the low coming in March 2009. The rich man's panic then, also known as the Knickerbocker crisis, was all about the withdrawal of credit. And this is how we were able to forewarn our clients about the 2007 crisis. This is exactly the same thing happened. Credit was free and easy, and then suddenly it all dried up. And of course, what happened here in the 1907 Knickerbocker crisis was that JP Morgan was called upon to help by the US government. The Federal Reserve wasn't even created at this point. So he was brought in as an advisor. And of course, 100 years later, although the ban had long passed, JP Morgan was heavily involved in one of the banks and the restructuring following the global financial crisis credit. But the story doesn't stop there, because if we go back another 200 years, we are seeing what happened right now. The Napoleonic Wars were on, and the United States wanted to remain neutral. So it brought in the Embargo Act. It ceased trading with most of Europe. It was passed by US Congress, and all trade was banned effectively with the rest of the world. It was sanctions on Europe, but it was an own goal. And in this case, the market actually came down 80% from what I recall. So you can see 1807, Embargo Act crisis, 1907, rich man's panic, 2007, global financial crisis. And you can see now, 2107 will be a significant event. Make that a note for you in your will there. But let's, for your kids and grandkids, taking the midpoints of these. So 1907 to 2007 says 1957, and we saw a recession in the United States. We saw just a secular bear market. Why did this occur? No great event other than everybody that could afford an automobile now had one. Everybody that could afford a television now had one. Everybody that wanted and could afford a refrigerator, a television, an automobile, all that stuff, they had it. It was a manufacturing peak. See, if you go back to 1929, one of the big constituents of the boom up into 29 was RCA, because everybody wanted a radio at that point. So this was a manufacturing peak. And in this case, the market came down 20%. So you can see 20% is a significant move down. Now, we return to the other midpoint between 1807 and 1907. This is the one I want you to write down because it falls in several cycles. As I said, this was the biggest banking failure in the United States to date, but it also had a European London banking failure and again, all the way across Europe. In America, it was all about the end of the railroad boom. In Britain, it was a peak in the Industrial Revolution, Britain leading the way in industrialization. And I think it was around about September 1857, off the top of my head, the Ohio Life Insurance and Trust in Cincinnati failed. They were dealing in railroad bonds, and that caused the house of cards to collapse. So you can see these are phenomenal events. And this is kind of a perfect example. Those of you that remember the 87 crash, which I do, you'll see that we got the high exactly 50 years to the day, 1937 pattern. It really sort of replicates from here up to the high. There's the spike low, then a little bit of a bump there slightly out. So history does repeat, and if it doesn't repeat, it certainly rhymes. So when we see these patterns coming together, how do we use it? What I'm going to do is start bringing it all together into actionable information. But we were prepared for in 2019-20 because we were 90 years on from the 1929 crash. We were 45 years on from the OPEC oil crisis. We were 90 years on from the 1930 collapse, 300 years on from the South Sea bubble, 300 years on from the Mississippi land crisis. So we were looking for bubbles as well as crashes. We were also 200 years on from the land panic from 1820 and also 1920. And what did we see happen to commercial real estate, certainly in London and in New York? You know, they went crashing down when the pandemic came in. So what happened in 2020? We got a pandemic. And that pandemic we forewarned our readers about back in 2018, because there's a very clear cycle set. And I'll come to that in a moment. 100, 200, 300, 400 year cycle set. But also February saw the high in the stock market, and we got the 90-year cycle kicking in with that 30 odd percent correction. Cryptocurrencies took off with the 300-year bubble. That was the forecast bubble that we had. We thought it would be cryptos, and the grains took off. And I'll show you this grain chart in a minute. So our follows had been pre-briefed, and just to confirm here, the other factor that came into play geopolitically, so I'm going to slide some geopolitics into this, is that China was on our radar in 2019. And of course, COVID was first identified in November, December 2019. And why was China in the news? 2019, head back 30 years. So we're looking at 30-year cycles. We just don't worry too much about these other cycles. There are a lot that we use and we weave them all together. Take 30 years back to 1989, and you may recall the iconic image of the student standing in front of the tank in Tiananmen Square, which basically heralded the revolution, the internal uprising there. But you can go back exactly another 30 years to 1959, and China sees the Tibetan uprising. So we've got 30, 60, double up 60, and in 1899, China was involved in a more international crisis with the Boxer Rebellion. But we're going to bring in one more cycle, which is the 82 to 84 year revolution and war cycle. And what we see was this was also the what I call it the revolutionary cycle point from the Long March and the rise of communism in China. So they all came together in 2019. China was in the news, arguably the origin of COVID-19, but also a rise to its supremacy that it's seeing right now. Now, just a quick whistle-stop tour of pandemic cycles. Back in 2018, we warned followers about a forthcoming pandemic, and it's based on 100-year cycles. So right now, as you know, 2019, well, I think we gave March 22 right this month as a potential point of this phasing out, and I think we're certainly plateauing. We can go back 100 years, 1918 to 1920 was the Spanish flu pandemic. Nothing to do with Spain. It actually, the origins of it were in the First World War, and it actually started in America. The Americans did not want people to know that there was a pandemic starting because they thought it was actually started at a military base. They didn't want the world to know that they might be losing soldiers to the pandemic. Spain was a neutral country. It's the only country that reported the pandemic. Hence, it's called the Spanish flu pandemic. Go back 1817 to 1824. The first cholera pandemic started in Russia, went around Asia and Europe, killed millions, tens of millions. Go back another 100 years, 1717 was the measles pandemic in North America, and also go back another 100 years to 1618, and we saw smallpox, which wiped out a lot of the first people of America. So you can see these 100-year cycles follow quite clearly. But the reason COVID-19 was so important was a sub-cycle aligned with the same window of around about March 2020, December 2019. So roughly an 18.6 year cycle. It's a generational cycle. You'll see it documented in the work at the Foundation for the Study of Cycles. And if we go back to November 2002, I remember being on a plane going from London to Australia, stopping off in Australia. I was in one of the nicer cabins. I was the only one sitting there up the front. And that's because nobody was traveling because of SARS. Everybody had masks on. Go back the same cycle, 1981 to 84, the discovery in inverted commas of AIDS and HIV, another pandemic. And you can take this back and we get to Hong Kong flu. So the point is the super macro 100-year cycles were triggered by a smaller 18.5-year cycle. So this is how it works. 2020 then had all the cycles in for stock market change, for China, and for the virus. And that's exactly what we saw. We saw the origins of the virus in China bringing down the stock market. And we prepared our people for that using these mathematical patterns. And the other thing I want to throw in, this 18.6-year cycle, well, when the pandemic broke out, effectively was accepted in round about March 2020. The one industry that was hit hard was the airline industry. Go back exactly 18 years and 6 months, and you get to September 9/11, when New York was attacked. And which industry suffered the most then? It was, in fact, the airline industry once again. So here's the Bitcoin boom. This was based on the South Sea bubble. This is the boom and bust that we were expecting. So we got a boom and we got a partial bust. Arguably it was a bust there. This is based on the 300-year cycle, South Sea bubble and Mississippi land crisis. Grains. Now I want to talk to you about this. Here we go. Back at this time period, we started seeing lows come in. Why? Because there was a famine breaking out in Russia. So it's all about Russia. Geographically, the cycle's repeating. Mathematically, in the market, it's repeating. Not only that, the world was leaving the Bretton Woods Agreement, and basically we're getting free floating currencies. The dollar's weakening, a huge weakening of the dollar. So we saw this massive tripling of wheat prices. And this is what we've seen up till last week. We forecast this. And by the way, so this is a 50-year low to low, pretty much to within a month. And we got one of our profit finding Oracle histogram spikes right here, right on that low. We knew about it in advance. And, you know, for those of you that are regular chartists, there's a very sweet little trend line here as well. So this is how we put this information together. Now, Simon and I were talking a few weeks ago. War cycles are topical. We briefed people about this last year, and our year ahead report showed these cycles. I'm going to give you an overview of why this conflict with Russia and Ukraine is significant, and it's not going to blow over very quickly. And by the way, Ukraine historically, well, presently, up till this conflict, has been the 5th largest exporter of wheat, talking about the last slide. So there is no crop being harvested this year because everybody is at war. And also there is nothing being planted for the next year. So this wheat problem is here to stay for a while. What we're also seeing here is the war cycles. We talked about this 82 to 84-year cycle briefly with regards to the Long March. If we go back to 1939 and add 82 years, that was the outbreak of the First World War. That takes us to 2021. 82 years, and then 84 years takes us all the way 21 to 23. And we are in the middle of that. But you can go back the same cycle, and in 1853 to 1856, the Crimean War was taking place, which involved France, Russia, England, and the Ottoman Empire. Okay, now ultimately Russia went on to lose that. But you can see the flavors repeating and the geographics repeating here as well with that. But like you saw with the pandemic, you saw the macro cycles, and there was a trigger smaller cycle. And that's exactly, oh, let me just add one more. We can take this further back into the American Revolutionary War there as well. So I think that's very important. We can take this back, as I was saying, into smaller trigger cycles, and years ending in 1 and 2 tend to see conflicts. And, you know, we can start off just quickly with, say, 9/11 in 2001, go back 10 years, Desert Storm, another 10 years, Falklands, then there were other crises. Go back 60 years, by the way, and we're seeing the Bay of Pigs and the Cuban Missile Crisis, 61, 62. And the Cuban Missile Crisis is what we were forecasting for this year. So that is quite significant. But 1941 then saw Pearl Harbor. And Pearl Harbor and 9/11 was 60 years apart. The only 2 times America has been attacked on its own soil. But what we're really saying here is that we are seeing the 10-year cycle, the decennial cycle for years ending in 1 and 2 to actually be triggering the bigger cycle in place. So that's the war cycles. Now, we did an extensive report that we published on the 4th of January explaining the full background of these war cycles and the ramifications, but outside the scope of this presentation. But also for the case for this year is that we talked about these 18-year cycles, double them up, 36-year cycles. We're 108 years from the outbreak of World War I. So very sadly, we are bringing in cycles from the Second World War, the First World War, the Crimean War, and the American Revolutionary War. Major cycles are coming together. That's why I think that whilst this immediate conflict might subside, there might be a ceasefire, I do think this is going to go on for 2 to 3 years. I'm going to bring in one more cycle, and then we're going to drill down. 2023, the 90-year cycle for 2023 sees Roosevelt banning the public hoarding of gold. They had to hand everything in at $34 an ounce. I think this is potentially going to see an impact on cryptocurrencies, and there might be big moves to try and have them banned or blocked. Anyway, well done for sitting through the history lesson. I hope you've got some interesting points there.